Hello everyone, thanks for checking out my video. The US stock market clocked its best week of 2024 as investors cheered on Federal Reserve's decision to keep interest rates unchanged and maintain its previous projection of 3 rate cuts this year. S&P 500 is on its way to hit a 5th consecutive winning month, a run that started since November last year. On top of that, the index has clinched 20 all-time highs this year alone and is on pace for its most record closes ever in a single year. With the reassuring economic outlook and dovish signals from the Federal Reserve, 2024's market rally looks unstoppable at the moment. But is that really true? And for those who hasn't been able to hop on this bull train, is it too late to enter now? Let's cover these questions in this video. As usual, watch on to find out more. It was a busy and eventful last week for the stock market with FOMC meeting, Nvidia's conference and Microsoft event taking place. On top of that, we also had lots of major news coming out from Tesla and Apple. But to me, the pivotal event was actually the FOMC meeting, specifically Jerome Powell's post-meeting conference. Basically, the Federal Reserve had decided to leave interest rates unchanged and, more importantly, maintain their outlook of 3 rate cuts this year, despite a recent series of hot inflation reports. And guess what? That was enough for this market to continue to move forward. As we all saw, following the Fed's decision, stocks were swept up quickly as investors perceived that the central bank wasn't as hawkish as initially feared. In fact, Jerome Powell didn't seem to be too concerned about the recent hot inflation reports. To add on, Powell's speech and the Fed's dot plot forecast had further encouraged investors to look beyond the massive growth in technology sectors only, as we saw other industries such as the financials, industrials, and energy sectors rallying last week as well. As shared, last week's market rally was likely due to a reaction to the positive news from Federal Reserve's meeting. With 6 weeks until the next FOMC meeting in May, attention will now be shifted to other drivers or catalysts. But with that being said, I am of the view that the upcoming few weeks have little catalyst to move the market drastically. In fact, this coming holiday shortened week is a much more quiet one as compared to last week. This means lesser drama. However, just to highlight, towards the end of this week, or to be more specific, on Friday 29 March, investors will be watching the new PCE price index, which will give us another sensing of where is inflation headed now. And on the very same day, Jerome Powell will be speaking at the San Francisco Federal Reserve branch event, so mark that in your calendar as well. Well, since the stock market is going to close on Friday due to a public holiday, don't be surprised if investors take some profits off the table leading into the long weekend with inflation report coming up and Powell's speech happening. And the end of the first quarter could also create a bit of volatility as fund managers and institutions adjust their portfolios. With all this being said, I don't think the movement will be anything major. But as I have always shared, let's try not to predict the market direction. Let's look for confirmation with the help of technical analysis, which brings me to the next section. Alright, as usual, starting things off with SPY. Ever since SPY breaks out of this green dotted uptrend channel, did some classic textbook retrace and retest of trend line, it almost never looked back with a solid bounce. At this point, the sky seems to be the limit. Okay, just kidding. I mean, in the long run, sky is really the limit. But for now, SPY is hitting the resistance level at 521. However, if SPY can somehow get above 521, then it's going to be another all-time high again, as I think there is a chance for SPY to charge towards 536. And just to highlight, 536 level is the 100% Fibonacci extension level where I plotted based on October 2023's low. At that level, it's really the sky is the limit, where we probably have to see something breaking in the economy to bring the stock market down. On the other hand, if we see some profit taking this week, any Fibonacci retracement levels you see on this screen is a potential point of rebound. So it's really up to individual on where would you like to enter to catch the next wave up. To be very honest, if SPY retraces back to 510 or 501, it won't excite me. I will only be excited if SPY falls towards the gap between 495 to 501. That's the kind of pullback I have been waiting since January this year. But that being said, some words of caution. If we ever get to this gap area this or next week, it should rebound if the bull rally were to continue. However, if this area gets breached, then I think there is a possibility for some catalyst in the market that is pushing the market down. Because below this area, it means that SPY has broken below the 50 moving average at 498 and potentially fall back into the green dotted channel. Anyway, this does look a little far-fetched at the moment, so meanwhile, let's take one step at a time, watch for the various Fibonacci levels for support first. Alright, moving over to Apple's chart. Well, last week I shared 3 key takeaways for Apple, and they are 175 as an important level for the bulls, the death cross, and a fake breakout, and everything was spot on. I specifically shared that if Apple goes above 175, it could ride the upside towards the gap at 177, and it did. Then I mentioned that above 175, if Apple retraces and falls back below the downtrend line, that is called a fake breakout. And from there, Apple's bearish momentum could continue. And that happened as well, as Apple has fallen back below the downtrend line with the big fat red candle. So for this week, the key levels to watch remains roughly the same. The purple downtrend line and 175 remain the key resistance levels that Apple needs to punch through decisively before we can say that there is a slight reversal in its bearish trend. Anything below these two levels means that Apple is still leaning towards bearish. Okay, but the saving grace is that we are still above the recent low of 168. It also appears to me that Apple is consolidating around this range of around 168 to 175. At this area, Apple has to defend 168, or maybe give and take a little bit and stretch it to 165, which is the October 2023's low. If 165 gets breached, I don't see much support below. That's when Apple may potentially grind towards the gap between 157 and 158. Just to add, remember the last time when we had a death cross, Apple fell 10% from 140's range to 120's range. So if that is of any indication, a 10% drop from the day when the recent death cross happened will put Apple at 155, pretty close to the gap area that I mentioned earlier. Okay, I'm not saying it's gonna happen, but as I have mentioned last week, death cross has proven to be a continuation of a bearish trend. So at this point, I will be very careful in opening any bullish trades until Apple has showed me some signs of a reversal. I will definitely update here when that happens. Let's now check out Tesla's chart. Wow, Tesla is looking dangerous for the bulls. There are 2 bear flags on the daily chart, and that's how bearish it is. And let me warn you first, if the second bear flag plays out, I think we could easily hit 150, and that's a 20 points drop or close to 12% drop from the current level. And mind you, Tesla is already down 30% year to date. Okay, so how do we look for confirmation that the bear flag could play out? Watch the flag marked out by the green dotted lines. If we break below that with 2 or 3 red candles with solid volume, then Tesla is very, very bearish. That is when I would expect Tesla to hit towards the gap between 146 to 152 and the bottom of the blue dotted downtrend line, which is around 145. This gap area and the channel line should provide some form of support if we ever come here. But if they don't even hold, believe it or not, at least for me, I think Tesla could waterfall to 120's range. Okay, but on the other hand, if Tesla can break above that bear flag and stays above it for a few days, then we could have a potential reversal in bearish trend. because above the bear flag would mean Tesla is also breaking out of the purple mid-channel line. From there, it gives Tesla a good probability to fill the gap at 184 to 186, or maybe even retest the 50 moving average at 190. Just to add, two small good news for Tesla bulls is that the MACD just had a bullish cross last week, despite Friday's mini sell-off. Also, the bullish RSI divergence is still in place so far, but I labeled them as small good news because the larger trend is still bearish, and also because Tesla is sitting dangerously at the bottom of this little bear flag. Okay, so if you can, try drawing out these two green dotted lines, aka the bear flag, on your chart. Then watch how Tesla moves this week. By the way, just a very quick shout out to the following viewers who have bought me super thanks last week. Appreciate your contribution and support. For other viewers who would like to support the channel, you may consider also buying me a YouTube super thanks or a cup of coffee via my Ko-Fi link. Otherwise, do at least consider liking, subscribing and sharing my videos as I continue to produce free content for everyone. Moving over to Google's chart. Well, I was wrong last week as I was guessing that Google may get rejected at either 142 or 145. But then, Google had that huge gap up on Monday and bypassed both 142 and 145. Well, this just further reiterates what I have always shared. One should not try to predict the next direction. So yep, I accept that my guess was wrong. Anyway, looking at the chart, I love how Google is hugging that green uptrend channel line so nicely. This is what I called a classic retest of trend line, and right now it seems like Google is having a little difficulty breaking above it. And this somehow makes this week's analysis slightly more straightforward. If Google can break back into the uptrend channel, that's bullish in my opinion. But a slight move back into the channel is not enough. Google has to break above the recent high of 153. Then yes, I would say Google is very bullish, because it means we have another new all-time high, and if you recall what I have shared, when we reach a new record high, the uptrend momentum will usually continue for a while more. And that's when I expect Google to have a chance to go towards the top end of this uptrend channel, which is around 160, before a meaningful resistance may come in. On the other hand, watch 153 carefully, because if sellers step in around that range, then we could potentially have a double top pattern, and that's bearish. Okay, another scenario would be Google continue to hug that channel line, gets rejected and continue to fall. When that happens, I would think the target for the bears is the gap between 143 and 146. This is first potential bounce area, as this is also where the Fibonacci level and 50 moving average are. But if Google doesn't bounce from there, we could say hello to 130's range again, and that is the area where I will consider picking up more Google shares. Alright, let's now hop over to the options trading segment. So, remember in my previous video, I shared about this cash secure put on Tesla that was in the red. Well, I must say I was a little lucky that the news on price increase of Tesla vehicles had helped push the price upward last week. Though we had a mini sell-off on Friday, the bounce that happened earlier in the week had ensured that Tesla stays above my strike price of 160 even on the expiration date, which was 22nd March. As a result, my contract expired worthless and I got to keep the full premium of $168 without having to close or roll my contract. If you wish to find out more on the rationale behind this trade, please check out the video linked at the top. Next up, I have sold a new cash secured put on Tesla last Thursday, 21st March, with a strike price of $145 expiring 26 April. Okay, I must say I have entered this trade a little early. If you could recall, in my last video I shared I would consider entering a trade either when Tesla is below 160 for a potential bounce, or I will wait for it to reclaim 180 for a trend reversal. And well, I sold this put contract when Tesla was at 170s, so I have to admit I was early. And then on Friday, Negative news on production cut in China has caused Tesla to decline back to 170, and my trade is in the red now. But just to note, this is not a incurred loss yet. Anyway, the reason why I opened the trade on Thursday was because MACD had a bullish cross. In the last 4 to 5 times when this happened, Tesla had a decent bounce. But the mistake I made here was that I didn't wait for further confirmations such as going above 180 or going above the purple downtrend line or even break out of the bear flag. In fact, it's quite a risky trade when the bear flag is still intact. But of course, all these high side views are always 20 out of 20. Anyway, I guess the key takeaway to share with my viewers is one should try to stick closely to his or her trading plan and sharing this mistake so that you could learn as well. Okay, with all that said, is it doom and gloom for this trade? Well, relax. First, this contract only expires late April. We still have time. Next, as I knew it was a slightly early trade, I actually selected a strike price that is below this gap to give myself more buffer. The bottom of the gap will act as a support. But if that breaks and Tesla goes below 145 on the expiration date, as usual, I can choose to either take assignment or I can roll the option. Actually, Tesla at 145 isn't that bad of a price in my opinion. Alright, for this end thoughts section, let's address the two questions that I posted at the start of this video. Namely, is the current rally really unstoppable, and is it too late to hop on this bull train? Well, before that, let's understand what's driving the market rally since the end of October last year. They are, in my opinion, market expectations of rate cuts by the Fed and the ongoing AI boom. As previously mentioned, at one point, the market expectation of the number of rate cuts was very misaligned with the Fed's, but right now, they are aligned. And the icing on the cake is that the latest FOMC meeting has not changed the expectations. As for the AI boom, I don't think I need to explain any further. I mean, with the latest products released from Nvidia and Microsoft during last week's event, Apple's potential collaboration with Google and Baidu for their AI tools, new ChatGPT upgrade, etc., I would say this AI revolution is at its infant stage only. So, from now till the next FOMC meeting, barring any black swan events or super hot inflation numbers, my view is that the overall market trend is still positive. Therefore, to answer the question on whether the current rally is unstoppable, well, what I can say is in the near term, I think the trend is still positive. The rally could continue. But if this changes in the months ahead, I will keep you posted, so please subscribe to my channel, okay? Anyway, my view is backed by the broadening side of the market rally, because apart from the tech sector, the financials, industrials and energy industries are also performing relatively well this year. The financial industry is up close to 10% and the energy sector is up around 9%, while the industrial side rose about 11%. For comparison purpose, S&P 500 is up around 10% year to date. This means that many of these industries that were lagging last year are catching up with the broader market index. This also shows that the latest rally is no longer solely driven by the Mag 7 or the big tech companies anymore. Okay, just a caveat, this does not mean that the rally will bulldoze its way up with S&P 500 hitting 6,000 anytime soon. As per my past sharings, market will not go up in one straight line. There will be pullbacks. I repeat, there will be pullbacks along the way. This will then address the next question, is it too late to enter the market now? The answer is a no if you are a long-term investor of solid companies. All you have to do now is to wait for pullbacks to enter. If you had followed my past videos, you would know that I stepped in for Apple and Google when they pulled back a few weeks ago. If I were to use the price that I entered and compare it with the current stock prices, my Apple position is up 0.7%, while Google is up 12.7%. Anyway, the market is getting a little overexcited right now after the latest FOMC meeting. Some investors are getting ahead of themselves again. So with market sentiment and technical indicators looking a little elevated, the next modest pullback could come this few weeks. That said, the pullback could be very minor, could be something that we saw in the past few weeks which you may not even realize that it is a pullback. So on this, I would say bookmark the stocks that you want to add to your positions, and if it reaches your target price, step in. Meanwhile, part of me is hoping for a larger pullback so that I can pick up more shares at cheaper prices. Honestly, when I look at SPX on the weekly chart, we only had 3 red weeks in the last 21. It looks almost to me like a straight line already. And the straighter the line is and the more parabolic it gets, the chance of a rug pull is actually higher. But of course, I am not betting heavily on the rug pull because it may or may not come. Therefore, my plan has been, regardless of the scale of the pullbacks, if I am in this market for a long time, any sort of pullbacks are opportunities to add to my positions. At the end of the day, my view is that long-term investors should stick to the fundamental story of the companies that they are invested in. Short-term volatility should not affect your thesis. Alright, that's all for this video. Do remember to like and subscribe before you exit the video, okay? Thank you very much.